As of 12:41 p.m. Eastern Time on October 28, 2025, Rezolve AI PLC, trading under the ticker RZLV, is priced at $4.65 per share. This represents a significant intraday drop of 19 cents, or nearly 3.93%. The stock opened the session at $4.81, below yesterday's close of $4.84, and has been grinding steadily lower, hitting $4.65 as its session low, which is exactly where it's trading right now. What's particularly interesting is that this decline is happening on relatively light volume. So far, just under 4 million shares have traded hands, which is well below its 19.33 million share average. This isn't a high-volume panic sell-off, it's a persistent, low-volume drift downwards, suggesting a lack of enthusiastic buyers willing to step in and support the price, even after this significant pullback from its 52-week high of $8.45, which it touched just last month. This price action is the perfect picture of a market in conflict, a stock caught between an incredibly ambitious corporate narrative and a series of deeply troubling realities. The expectation, the story that the company is actively promoting, is one of explosive growth and market-defining technology. If you just read the press releases, you'd believe this is the next major AI infrastructure play, perhaps the next NVIDIA stock for the e-commerce sector. Rezolve AI has been telling investors it is building the backbone for Agentic Commerce. The company recently announced major strategic partnerships with giants like Microsoft and Google, which it claims are not just marketplace listings, but deep joint go-to-market commitments. They've also partnered with Tether to integrate crypto payments. They followed this by raising an impressive $200 million in a private placement, which they said was oversubscribed. They've been acquiring companies like SmartPay and Subsquid to build out their payments and data infrastructure. And most impressively, they recently reaffirmed aggressive guidance, projecting a $150 million annual recurring revenue exit rate for 2025 and a massive $500 million ARR target for 2026. This is the kind of story that gets traders on the Robinhood app excited, looking at Robinhood fractional shares as a way to get in on the ground floor. But then we have the reality of today's $4.65 price tag. The market is telling us it doesn't fully buy the hype. The stock is nearly 50% below its recent peak. Why? Because while the headlines have been glowing, the counter-narrative is just as strong, and it's backed by some very serious concerns. The first crack in the armor appeared in late September, when short seller Fuzzy Panda Research published a scathing report. This report alleged that Rezolve, which had roots in mobile ticketing, simply suddenly declared itself an AI company. The short seller claimed that its AI-related revenue was effectively zero, and that its strategic $10 million partnership with Google had resulted in an app with no reviews. The company, as you would expect, categorically rejects all these claims, labeling them as misleading and inaccurate. But a short report from a known entity isn't something the market just brushes off, especially when it's followed by other issues. The company is also entangled in significant ongoing litigation with former financing partners, including Yorkville and JBM, over a failed $1 billion Bitcoin financing agreement from earlier in the year. These aren't small distractions, these are major legal battles that can drain capital and management focus. This brings us to the actual financial performance, the numbers behind the narrative. While the company celebrated a 426% year-over-year revenue growth for the first half of 2025, that growth came off a very small base. When you look closer at the most recent quarter, Q2 2025, Rezolve's revenue of $4.88 million missed analyst expectations of $6.75 million by a wide 27.7%. That is a significant miss for a company guiding for such exponential future growth. Furthermore, the company is burning cash at an alarming rate. Its adjusted EBITDA for the first half of the year was a loss of $17.7 million. This context makes that $200 million private placement look less like expansion capital and more like a necessary lifeline to fund operations. This is the kind of fundamental analysis that investors using Fidelity Wealth Management or managing their own individual brokerage account must consider. It's not as simple as the headlines suggest. The stock's performance isn't an anomaly, it's a direct reflection of this tension. The run-up to $8.45 was driven by the roadshows and the funding news. The subsequent crash was a direct result of the short report and the market digging into that Q2 revenue miss. Now, the stock is trying to find a floor, and today's drift down to $4.65 shows it hasn't found it yet. So what does Rezolve AI actually do? Or at least, what does it claim to do? The company's core offering is its Brain Suite, an AI-powered platform for e-commerce. This includes Brain Commerce for search and personalization, Brain Checkout for streamlined transactions, and Brain Power, its own proprietary large language model. The idea is that this suite enables Agentic Commerce, where AI agents can autonomously search, transact, and personalize experiences for users. They list major clients like H&M, Ferrero, and Urban Outfitters. By acquiring SmartPay, they're adding digital and crypto payment rails. And with SubSquid, they're adding a data layer. In theory, they are building a vertically integrated stack for the next generation of online shopping. This is the investment thesis. It's a compelling vision, one that sounds like it could disrupt how all online investing sites and e-commerce platforms operate. But this is where the self-investing part becomes so critical. You have to weigh that vision against the Fuzzy Panda claim that this is all just ChatGPT wrappers and that the real business is something else entirely. For the average person looking for investment help or using a SoFi robo-advisor, this stock is probably a non-starter. It's far too speculative. This is a stock for active traders who are comfortable with extreme volatility and binary outcomes. Someone using the Interactive Brokers platform for its advanced charting and data might be watching the flow, looking for signs of institutional accumulation or further distribution. Someone with a Fidelity brokerage account might be reading the fine print on the lawsuits, trying to determine the potential liability. This is not a buy and hold for your Fidelity IRAs. It's a high-stakes bet. Many investors prefer the stability of Fidelity mutual funds or broad market Fidelity ETFs precisely to avoid this kind of single-stock risk. This isn't Apple stock or Tesla stock, where the products are tangible and the business models are proven, even if their valuations are debated. Rezolve is an idea, a very expensive idea that is still in the process of proving it can become a viable business. Platforms like SoFi Invest and Robinhood Investments make it easy to buy, but they don't make the decision any less risky. The SoFi investing platform might list SoFi stocks and SoFi ETFs that offer a more diversified approach, which stands in stark contrast to a single-stock gamble like RZLV. Based on this deep conflict between the company's story and its current challenges, I have to ask, what do you believe? Comment below if you think Rezolve is a genuine AI builder on its way to $500 million in revenue, or if you think the short seller report has merit and this is a house of cards. Looking forward, the path for RZLV is incredibly divergent. The bull case, the expectation, is that the company is right. The bull case is that the $200 million placement, combined with its existing cash, is more than enough to bridge the company to profitability, which it has guided for in the first half of 2026. In this scenario, the lawsuits are dismissed as frivolous, the short report is forgotten, and the Microsoft and Google partnerships begin to contribute the massive revenue figures Rezolve has projected. The company successfully scales its Brain Suite and hits its $150 million and $500 million ARR targets. If all of that happens, then $4.65 is an absurdly cheap entry point, and investors who buy now will be rewarded handsomely. This is the online investment dream. Then there is the bear case, the reality that the market seems to be pricing in today. In this scenario, the cash burn continues to accelerate, and the Q2 revenue miss was not a blip but the beginning of a trend of overpromising and under-delivering. The lawsuits prove to be a significant drain, or worse, result in a damaging judgment. The strategic partnerships fail to produce meaningful revenue, and the core technology is exposed as being less proprietary than claimed. In this world, the company will be forced to raise capital again, likely at much lower valuations, diluting shareholders and sending the stock spiraling back to its 52-week low of 107 cents. This is the risk of online investing in speculative technology. It's why many prefer automated intelligent portfolio services like Schwab Intelligent Portfolios, which are designed to avoid this exact kind of volatility. Ultimately, the story of Rezolve AI is a stark reminder of the gap that can exist between